Boston, October 1868. On a courtroom table lay two signatures attributed to the same dead woman. To the eye, they matched. To the experts, they matched too well. Chemists, engravers, bankers, and handwriting specialists argued that one name had been traced from the other. Then Harvard mathematician Benjamin Peirce translated that suspicion into an immense statement of probability. The woman relying on the disputed paper was Henrietta Robinson, soon known as Hetty Green. She would become one of the richest financiers in America, and newspapers would call her the Witch of Wall Street. But the paradox begins here. The evidence that made the case famous did not decide it. Was this an exposed forgery, a failed inheritance claim, or the birth of statistical forensics in an American courtroom? The surviving judgment gives a narrower answer than the legend. Henrietta Howland Robinson was born in New Bedford, Massachusetts, on November 21, 1834. Her father, Edward Mott Robinson, was a Quaker whaling agent and oil manufacturer. Her mother, Abby Howland Robinson, came from another powerful whaling family. The money behind Hetty Green did not begin with a lucky trade. It came from ships, rendered whale oil, merchant credit, and a port tied to a global industry. According to the account she later gave of her childhood, poor eyesight in the family meant that she read financial news aloud to her father and grandfather from an early age. By her teens, she was helping with accounts. The later caricature presented a mysterious woman who appeared on Wall Street in black. The record begins somewhere more practical, beside ledgers in a household where capital was discussed as daily business. The lesson was not simply how to save. It was how to inspect an asset, wait for a favorable price, and keep control of the proceeds. New Bedford merchants lived with long voyages and uncertain returns. A ship might disappear beyond the horizon for years, leaving its owners to measure risk from letters, cargo prices, and accounts. Hetty learned inside that culture. Later profiles reduced her method to miserliness because frugality was easy to describe. Her actual work demanded something less visible. She compared securities, watched borrowers, studied collateral, and kept enough cash to act when other investors could not. In 1865, that education became consequential. Within weeks, 2 deaths transferred large family interest toward her. They also placed much of that wealth behind trustees, creating the grievance that led to the signatures on the Boston courtroom table. Edward Mott Robinson died on June 14, 1865. His will gave his only child $910,000 outright, along with San Francisco real estate and income from trusts holding further assets. Soon afterward, his sister Sylvia Ann Howland also died. Her estate was valued at approximately $2 million. The will admitted to probate placed about half in trust for Hetty and directed the remainder through other bequests. Hetty first challenged that will by claiming her aunt had lacked legal capacity, then withdrew the appeal. She had still inherited substantial wealth. What she did not receive was unrestricted command of everything she believed had been promised. The dispute was not about poverty or survival. It was about control. In a financial life defined by direct management, a trust was both an income and a restraint. Hetty took a different claim into the United States Circuit Court for the District of Massachusetts. She said that she and Sylvia had agreed to leave their property to one another, to hold copies of the wills, and not to make another will without notice. To support that contract, Hetty produced an earlier will attributed to Sylvia. It left the estate to her. A second page, written in Hetty's hand but bearing Sylvia's signature, declared that the document would revoke wills made either before or afterward. The executor, Thomas Mandel, denied that any binding agreement existed. His side accepted the signature on the first page as genuine, but said the signature on the added page had been forged. That turned an inheritance suit into a question about what ink, handwriting, and mathematics could prove. The defense assembled an unusually broad group of experts. They examined the forms of the letters, the placement of the writing, and the relation between the two signatures. Their central observation was simple. Natural signatures vary. These two corresponded with an exactness they considered artificial. Benjamin Peirce, a Harvard mathematician, gave the most memorable evidence. He calculated that an accidental duplication of all the examined features would occur only once in billions of cases. His assumptions would face scrutiny from later statisticians, but the historical importance remains. The Federal Judicial Center describes Robinson v. Mandel as probably the first federal case in which statistical evidence was presented. A family will dispute had become an early demonstration of numbers used as forensic testimony. Justice Nathan Clifford did not decide whether the signature was genuine. Federal law and Massachusetts rules prevented Hetty from using her own testimony about transactions and statements involving her dead aunt against the executor. Once those portions of her deposition were excluded, Clifford found that the remaining evidence did not prove the alleged agreement between the two women. On October 15, 1868, the bill was dismissed with costs. No jury reached the forgery question. No criminal conviction followed from this case. That precision matters. Later retellings often say that a court found Hetty guilty of forging the will. The published opinion says something different. Her civil claim failed because the contract was not established with competent evidence. The signature remained under a powerful cloud of expert suspicion, but the court expressly declined to rule on its truth. By the time of the decision, Hetty had married Edward Henry Green. The marriage took place in 1867, with an agreement protecting her property from his debts. The couple lived in London for several years, where their son Edward, known as Ned, was born in 1868, and their daughter Sylvia in 1871. The failed suit had not erased Hetty's capital. She still held the outright inheritance from her father and received income from the family trusts. She deployed that base into government obligations, railroad securities, mortgages, loans, and real estate. This was not a sudden fortune made by clipping coupons in cheap rooms. It was a long practice of selecting claims on businesses and property, demanding security, and preserving enough liquidity to buy when prices weakened. A contemporary business biography published in 1895 listed Hetty Green as a holder of railroad shares, Chemical National Bank stock, Chicago real estate, and other property. She also became known as a lender against strong collateral. Her own public explanation rejected margin speculation. Stocks, she said, were bought as investments, not with borrowed money to magnify a wager. That distinction separated her from many celebrated operators of the Gilded Age. Market corners and promotions could create spectacular paper fortunes, then destroy them when credit tightened. Green's method was slower. She looked for sound claims that depressed prices and kept cash available. Her plain dress and low personal spending became the part reporters could photograph. The balance sheet behind them was the source of her power. The panic of 1907 revealed the value of that liquidity. A failed attempt to corner United Copper helped trigger runs on trust companies and a wider shortage of cash. J. Pierpont Morgan organized the most famous rescue meetings, but Green entered the crisis with money available to lend. Financial histories record that she advanced $1.1 million to the government of New York City at the height of the panic, receiving short-term revenue bonds in return. She also made loans to private borrowers as credit vanished elsewhere. The point is not that she rescued the system alone. She did not. It is that the supposed miser had built the one asset a panic makes scarce, ready cash. Her restraint in prosperous years gave her leverage when banks and speculators were forced to ask for it. The nickname Witch of Wall Street belonged to the newspaper age that surrounded her. Period reports emphasized black clothing, cheap lodgings, arguments over small expenses, and the spectacle of a wealthy woman using bank space instead of a grand private office. Some accounts were based on observable habits. Others grew through repetition. Stories about cold oatmeal, unwashed dresses, tax avoidance, weapons, and her son's medical care circulated in profiles that often mixed reporting with moral theater. The archive proves that these claims were printed. It does not make every claim true. The gendered contrast was useful to editors. Male financiers could be called bold or ruthless. Green's severity, independence, age, and mourning clothes were condensed into a supernatural label. The witch sold a simpler story than a specialist in bonds, mortgages, and distressed credit. Hetty Green died at her son's home in New York City on July 3, 1916. She was 81. Newspapers estimated her fortune at about $100 million, with some placing it higher. Those figures were estimates, not a final inventory. Her will did not supply the accounting that would have settled the number. On July 22nd, it was admitted to probate in Bellows Falls, Vermont without a family contest. Nearly all of the estate passed in equal shares to Ned and Sylvia. The woman who had spent decades measuring collateral left behind a fortune the public could not measure exactly. That uncertainty helped the mythology survive. A round number moved easily from obituary to biography, while thousands of mortgages, securities, and parcels resisted a single dramatic total. Return to Boston and the two signatures. The experts saw a match too exact for ordinary handwriting. The judge saw a contract that could not be proved under the rules of evidence. The public saw a woman already easy to cast as avaricious, unnatural, and strange. All three records survived, but they do not say the same thing. Hetty Green cannot be reduced to an acquittal, a conviction, or a nickname. She was an heiress who enlarged inherited capital through disciplined finance. She was also the claimant in a will case built around a document that formidable experts called a tracing. The lasting evidence is the distinction the legend usually erases. Suspicion is not judgment. Estimate is not inventory. A printed story is not proof. In this case, the calmest account is also the most unsettling, because the public record preserves the question and the limits of its answer.